The biggest threat to your investment returns is not the stock market. It is not inflation. It is not the economy. It is you. Studies consistently show that the average investor significantly underperforms the market, not because they picked bad investments, but because they made avoidable behavioral mistakes. In this video, we will cover 5 of the most common investing mistakes and show you exactly how to avoid each one. Mistake number 1 is trying to time the market. Investors constantly try to predict when the market will go up or down. They sell when they think a crash is coming. They buy back in when they think things are safe. The problem is that nobody, not professional money managers, not economists, not individual investors, can consistently predict short-term market movements. A study by Schwab found that investors who tried to time the market earned significantly less than those who stayed invested. Missing just the 10 best trading days over a 20-year period cut your total returns by more than half. The solution is simple. Do not try to time the market. Stay invested. Time in a market beats timing the market. Mistake number 2 is ignoring fees. A 1% annual fee does not seem like much, but over 30 years, that 1% can consume about 30% of your returns. On a $500,000 portfolio, that is roughly $150,000 paid to fund managers instead of staying in your pocket. Many investors do not even know what they are paying. Actively managed funds charge 1% or more. Index funds charge as little as 0.03%. The difference is enormous. Always check the expense ratio before buying any investment. It is the single most predictable factor in your future returns. Mistake number 3 is lack of diversification. Putting all your money into one stock, one sector, or one type of investment is very risky. If that investment does poorly, your entire portfolio suffers. We saw this when Enron collapsed. Employees who had all their retirement money in Enron stock lost everything. Diversification means spreading your money across different investments, different stocks, different industries, different countries, and different asset classes like stocks, bonds, and real estate. The simplest way to diversify is to buy a total stock market index fund. It gives you thousands of companies in one investment. Diversification is the only free lunch in investing. Mistake number 4 is emotional investing. When the market drops sharply, fear takes over and investors sell at the worst time. When the market is soaring, greed takes over and investors buy at the highest prices. This is buying high and selling low, the exact opposite of what you should do. The best investors ignore the daily headlines and stick to their plan. They understand that market downturns are completely normal. They actually welcome them because they can buy more shares at lower prices. The solution is to automate your investments. When contributions happen automatically, you do not have to make emotional decisions. Mistake number 5 is the most costly. Not starting at all. Many people wait for the perfect moment. They want to learn more. They think they do not have enough money. They want to wait for a market dip. But the perfect moment never comes, and the cost of waiting is enormous. Investing just $100 per month from age 25 to 65 at 8% grows to over $300,000. If you wait until 35, that same amount grows to only about $150,000. A 10-year delay costs you half. If you wait until 45, you end up with $60,000. The best time to start was 10 years ago. The second best time is today. Here is a simple system to avoid all 5 mistakes. First, automate your investments. Set up automatic monthly purchases of a low-cost index fund. This eliminates market timing. Second, use only low-cost index funds. Fees stay near zero. Third, buy a total market fund for instant diversification. Fourth, check your portfolio no more than once a month. This prevents emotional reactions. And fifth, start right now. Open a brokerage account this week. Even $25 is enough to begin. The habit matters more than the amount. These simple rules will help you avoid the most common mistakes and build real wealth over time. Do not try to time the market. Pay attention to fees. Diversify your investments. Keep emotions out of it. And start as early as possible. Avoid these 5 mistakes, and you will keep thousands more in your pocket. Start today. Your future self will thank you.